Welcome to Portfolio Insights, the show that dives into the strategic decisions facing today's asset managers. I'm your host, Katie.
And I'm Brett. It's great to be with you. Today we are tackling a subject that's a persistent challenge for anyone managing a mortgage portfolio, the non-performing loan.
Specifically, that critical decision point when a loan hits 90 plus days delinquent. As a manager, you're at a crossroads. I mean,
Right.
the options seem straightforward, but choosing the most profitable path is incredibly complex. What's your first move?
That's the million-dollar question, isn't it? You can try to work out a new arrangement with the borrower,
Right?
which is often the hope. You can initiate foreclosure, the traditional but arduous path. Or you can pursue a faster exit, like selling the note itself to a private buyer.
And each of those routes has a dramatically different profile when it comes to, time, cost, and risk.
Yeah.
A loan workout is ideal if it succeeds, but the outcome is just deeply uncertain. Foreclosure can feel like the by-the-book answer,
The default setting for sure.
but it's notorious for being a slow, capital-intensive process that can drag on for months, if not years.
That really is the heart of the dilemma. It's difficult to compare these options on an even playing field.
Okay.
How do you weigh a potentially higher gross recovery from a foreclosure in, say, 18 months against a slightly lower but immediate and certain cash payment from a note sale today?
It's a classic net present value problem,
Right.
but with a lot of moving parts.
Right.
You have to forecast legal fees, property taxes, maintenance, insurance, sales commissions. This is precisely where a quantitative framework becomes essential.
Yeah.
You have to move past a gut feeling.
And this is where a tool like the NPL Resolution Options Calculator from Buckingham Partners becomes so valuable. It's a simple, elegant tool on our website that accomplishes a very difficult task.
Okay.
It allows you to model and compare the net financial outcomes of foreclosure versus a note sale.
Okay, let's make that tangible for our listeners.
Yeah.
Imagine a loan with a, say, $500,000 unpaid balance on a property you estimate is worth about the same. The calculator prompts you for the data points you already know,
Yeah.
but may not have consolidated.
Right. Estimated legal fees, say $25,000, estimated holding costs, and realtor fees. Now, when you input that data over a realistic 12 to 18-month foreclosure timeline,
Right.
the projected net recovery can be surprisingly low.
Exactly. The calculator just illuminates all those hidden costs. So while you're spending a year and a half to maybe net, $420 from an REO sale?
You could have sold that same note in less than a month. The calculator might provide a note sale estimate of, say, $430,000.
Wow.
In that scenario, the quick exit isn't just about speed, it's demonstrably more profitable.
And that clarity is the game changer. Suddenly the conversation shifts from a vague institutional policy of we always foreclose to a sharp, data-driven conclusion.
Right.
This note sale nets us $10,000 more and frees up our capital 17 months sooner.
Yeah.
It just crystallizes the immense opportunity cost of a long, drawn-out legal process.
This brings us to the note sale itself. For many lenders, especially smaller banks or credit unions, it can feel like an unfamiliar process. The idea of simply selling the problem, it sounds almost too easy.
But it's a standard and highly efficient transaction
Right.
when you work with the right partner.
Exactly. A boutique specialist buyer like Buckingham Partners focuses exclusively on this. Our entire model is built to provide a discreet, fast, and reliable exit for lenders who have done the math and realized a sale is their best strategic move. We provide a firm offer based on our due diligence, the paperwork is executed, and the non-performing loan is converted into immediate liquidity.
Wow.
It's off your books. The headache is gone. Your team can then refocus on what they do best,
Which is,
originating new performing loans.
that's the ultimate goal. I mean, you're in the lending business, not the property management or foreclosure litigation business.
Exactly.
A note sale is really about sharpening that focus and optimizing your balance sheet.
Absolutely. So, for any portfolio manager out there staring at a list of delinquent assets, the key is to stop analyzing each option in a vacuum.
Right?
You need a comparative, quantitative view.
And a great first step is to use a tool like the Buckingham Partners Calculator to get that clear numbers-based perspective.
Yeah.
If the data points toward a note sale being the superior option for your asset, it is absolutely worth exploring.
It is. And for any manager who wants to discreetly sell a note and get a real world quote for their asset, the path is simple.
Okay.
Reach out to the team at Buckingham Partners. You can see just how clean that exit can be.
A perfect summary, Brett.
Yeah.
The most profitable decision always starts with the best data.
Now, here's a question we'd like you to think about. Beyond the numbers that a calculator can model, how does your organization currently account for the non-financial cost of management time, focus, and morale when deciding on an NPL strategy?